We're going to talk about the repo today. You all know about the repo market, the Fed's reverse repurchase program. If you're not sure what a repo is, we're going to go into that a little bit as well. But repo, it's came down quite a bit since when? About October-ish of last year, which is essentially the same time that the market started to pump. But not so fast. The repo, this thing. It started right after COVID. There was this thing called SLR, which essentially allowed unlimited leverage for the largest players in the market, which is when we saw them buy up the entire market in 2020 to 2021 and accumulated everything as rates were low. And then as soon as the interest rate started to rise, so did the repo, and it went to historic levels, reaching upwards over of $2 trillion transacted daily. And since then, as we can see in this graph, it's came down all the way to where we basically started, right around that $150 to $200 billion range. Now, not so fast. Because, however, although the standard RRP has been coming down from the Federal Reserve, there exists another monster. And this is the sponsored repo. Now, this came from a SEC rule back in 2023, which it was adopted to improve risk management in clearance and settlement and facilitate additional central clearing for the U.S. Treasury market. Now, the release says on December 13, 2023, the Securities and Exchange Commission today adopted rule changes to enhance risk management practices for central counterparties in the U.S. Treasury market and facilitate additional clearing of U.S. Treasury securities transactions. The rule changes update the membership standards required of covered clearing agencies for U.S. Treasury market with respect to a member's clearance and settlement of specified secondary market transactions. So wait, hold on a second. What's a secondary market? A secondary market is a financial market where investors can buy and sell securities that have already been issued, such as stocks, bonds, options, and futures, where you and I trade every day. The term secondary refers to the fact that these securities are traded in a secondary market after they have been issued in a primary market, which is the markets we're discussing in this video. Now, the $26 trillion Treasury market, the deepest, most liquid market in the world, is the base upon which so much of our capital markets are built, said Sec Chair Gary Gensler. Having such a significant portion of the Treasury markets uncleared, which is 70 to 80% of the Treasury funding market and at least 80% of the cash markets, increases system-wide risk. Today's adopting release addressing clearance of Treasury securities in two important ways. First, the final rules make changes to enhance customer clearing. Customer clearing. Second, the final rules broaden the scope of which transaction clearinghouse members must clear. I am pleased to support these rules because they will help to make the Treasury market more efficient, competitive, and resilient. Right. So, specifically, the amendments require that covered clearing agencies in the U.S. Treasury market adopt policies and procedures designed to require their members to submit clearing certain specified secondary market transactions. These transactions include all repurchase and reverse repurchase agreements collateralized by U.S. Treasury securities entered into by a member of the covered clearing agency, unless the counterparty is a state or local government or another clearing organization, or the repurchase agreement is an inter-affiliate transaction. All purchase and sale transactions entered into by a member of the clearing agency that is an inter-dealer broker, and all purchase and sale transactions entered into between a clearing agency member and either a registered broker-dealer, a government securities broker, a government securities dealer. So, further, the amendments permit broker-dealers, this is where we come into play, to include customer margin required and on deposit at a clearing agency in the U.S. Treasury market as a debit in the customer reserve formula, subject to certain conditions. In addition, the amendments require covered clearing agencies in this market to collect and calculate margin for house and customer transactions separately. Finally, the amendments require policies and procedures designed to ensure that covered clearing agency has appropriate means to facilitate access to clearing, including for indirect participants. The amendments also include an exemption for transactions in which the counterparty is a central bank, sovereign entity, international financial institution, or a natural person. The amendments will go into effect in 2 phases, with the changes regarding the separation of house and customer margin, the broker-dealer customer protection rule, and access to central clearing required to be completed first by March 31st, 2025. After that time, the requirement to clear specific transactions would go into effect in 2 phases, with cash transactions being required to be cleared before repurchase transactions are required to be cleared. So again, cash transactions being required to be cleared before repurchase transactions are required to be cleared. Compliance by the direct participants of a U.S. Treasury Securities Central Clearing agencies with the requirement to clear eligible secondary market transactions would not be required until December 31st of this year and June 30th of next year, respectively, for cash and repurchase transactions. So this is very important shit in the works. Now you might be asking yourself, what the fuck? What's the sponsored repo? Well, we can actually track this information not through the Fed Reserve, but through the Office of the Financial Research, OFR, which has a lot of different data sets pertaining to this field. Now, it says here that this data are aggregated daily, and they are aggregated daily repurchase agreement volumes transacted via the Fixed Income Clearing Corporation's sponsored repo platform. Sponsored repos are secured borrowing transactions where FICC member dealers sponsor non-dealer counterparties, in other words, hedge funds, that need to borrow cash. Sponsored reverse repos are secured borrowing transactions where FICC member dealers sponsor non-dealer counterparties, e.g. money market funds, that want to lend the cash. Sponsored repo and reverse repo transactions are centrally cleared via FICC sponsored platform. Hedge funds borrowing cash comprise the majority of sponsored repo volumes, whereas money market funds lending cash comprise the majority of sponsored reverse repo volumes. So there you go. On one side, the repo side, you have the hedge funds. On the reverse repo side, you have the money market funds. One is lending and one is borrowing. Hedge funds are the ones borrowing cash, and the money market funds are the ones that lend the cash. Now, there's a good paper on this that goes over the sponsored repo. I'll link that below. I'm not going to read all of this to you verbatim, but essentially I'll give you the good points. Basically, they're saying that since the COVID-19 pandemic, treasury markets have experienced a lot of fluctuations in the way they've been functioning and a lot of disruptions. These disruptions have highlighted the important role of intermediaries and raised questions on identifying the drivers of spreads charged by these firms. This paper evaluates the salient forces behind a dealer intermediary's decision to move a bilateral repo transaction with a customer interested into central clearing. This is done by studying what are the main drivers of volumes and spreads of sponsored repo using detailed trade level data. And they begin by explaining the institutional arrangements of sponsored repo, how it differs from other, more well-studied segments, and then they lay out the potential costs and benefits for dealers, customers, and so on and so forth. So, what is a repo? A repurchase agreement, aka a repo, is a legal contract entered into by market participants. It documents the sale of securities for cash on a specific date, paired with repurchase of those same securities for a specific price at a future date. The terms of trade for repo involve, number one, the total amount of the securities to be exchanged as well as the specific securities to be delivered. Number two, the price of the securities on the initial date. And three, the price of the securities on the return or second date. Although market participants enter into repo contracts for a variety of reasons, we can group these motivations into 2 general categories. The first is to source funds, in which case the repo can be viewed as similar to a secured loan. The party delivering the securities on the initial date is seeking to obtain cash or money market funds, and the securities serve as collateral. In these cases, the difference in the price of the securities across the 2 negotiated prices, or negotiated dates rather, of the repo can be converted into a rate of interest on the cash, and that rate can be interpreted as the value of cash in the marketplace. Now, the second general reason that participants enter into repo contracts is to source securities. In this case, the participant delivering cash on the initial date is seeking to acquire specific securities for a set amount of time. as when sourcing cash, the difference in price of the securities across the two negotiated dates can be converted into an interest rate. In these instances, the rate usually reflects the demand and supply pressures for the security. When a specific security is in sparse supply, for example, the implied interest rate can be negative. Now, what's interesting about this area is that there's not much data on the uncleared bilateral segment of the repo market, and so less is known about its structure. The segment is largely a market between broker-dealers and their customers, where a dominant portion of activity involves levered customers. In contrast to the inter-dealer market, the network within the uncleared bilateral space is not considered dense. Dealer-to-customer trades are executed using a number of channels ranging from voice to request for quote platforms. Trades in this segment are not centrally cleared, but rather are bilaterally cleared and settled with each participant using their own clearing and settlement arrangements. Now, how does a sponsored repo service fit into this market structure? Well, the sponsored DVP service, or sponsored repo by the FICC, their product offering expands the set of trades which can be centrally cleared by bringing in these dealer-to-dealer and dealer-to-customer trades. The service differs from the previously explained central clearing services like the repo and reverse repo. Crucially, the aforementioned in this paper GCF repo are only available to direct clearing members of FICC, which, as indicated in the name, directly interact with the FICC. The sponsored repo service differs in that it allows customers of direct clearing members indirect access to FICC. Direct clearing members who bring on customers become a sponsoring member, and their customers is referred to as a sponsored member. The costs and benefits of sponsored repo differ substantially from those offered by GCF repo and the FICC DVP. And it says here, note that in late 2021, FICC introduced a related service, the Sponsored General Collateral Service Repo, or Sponsored GC. This service clears and settles trades on the tri-party settlement system run by the Bank of New York Mellon. Currently, the volumes of activity clearing in Sponsored GC are a fraction of those cleared in the Sponsored Repo, although that may change given the SEC's mandate around central clearing that we discussed at the beginning of this video. Now here's an empirical description of a sponsored repo. You can read this if you want. Basically, the data allows to see a great amount of detail, including specific securities exchanged, the principal amount, repo rate, and counterparties involved. The FICC's DVP service clears both Treasury securities and agency debentures. However, trades involving Treasury securities make up more than 99.9% of trades in terms of value. To provide a cleaner analysis of the data, we exclude trades involving agency debentures from our empirical analysis. Now, the detailed trades captured in the data allow us to distinguish amongst trades based on whether they are between direct clearing members of FICC or between sponsoring members and sponsored members. We classify trades where sponsored member is borrowing cash as sponsored borrowing, whereas trades where sponsored member is lending cash are classified as sponsored lending. And this data can be found at the OFR's website, which we're going to look at right now. So this right here, you have sponsored repo volume, and then we have sponsored repo reverse repo volume. So what we learned from the filing is that the repo side is going to come from the hedge funds, and the reverse repo side is going to come from the money market funds. So as you can see, they're both clearly on the upward trajectory since around the beginning of 2023, which is interesting timing. But in addition to these data sets, you have such a high amount of them to look at. So I'm going to go back here to FICC sponsored repo. You have two data sets out of the sponsored repo, but for the SCOOs, which is the Credit Officer Opinion Survey on Dealer Financing Terms, you also have the CFTC Financial Futures. Lots and lots of data sets here. So, for example, we have net short positions in the S&P 500 and the VIX. So leveraged funds, long notional position in VIX index futures. So lots of stuff to look at here. But anyways, I wanted to bring in this video just to kind of give you an idea that even though the repo has been draining from the Fed, we still have the sponsored repo that is skyrocketing in daily transaction volume. So, and as of today, or as of the latest reading that we have, it is up to $740 billion. So, yeah. Anyways, hope this one made sense for you. There's a lot of moving pieces for macro, and this is a whole nother area to look into for those who are interested.